All right, everybody, welcome back to Financial Friends. Today, I want to talk about what is an ETF, should we invest in ETFs, how do ETFs work, and all of the basics regarding ETFs. So I hope that you guys are able to pull something and learn something from this video. I'm going to lean heavily on a bunch of different resources that they will all be linked below. I want to make sure that people understand that it is okay to lean on resources and use them as long as they are credible and are coming direct from the source. I think it's very important that people do use resources and are not afraid to reference them when speaking about, investing, stocks, etc., etc. So what is an ETF? Let's get right into it. The first thing I want to touch on and make abundantly clear, and if there's only one thing that you take away from this video, the most basic answer to what is an ETF is it is a basket of securities or stocks, assets, whatever you want to call it. It is a basket of them. As you can see here, there's a basket, and it is including inside of it Apple, Google, Tesla, Amazon, Nvidia, and Meta. That is the most basic version and explanation. And if you want to click off the video now, if that was all you came for, you can go ahead and do so. Just make sure you drop a like before you leave. Also subscribe and hit the notification bell so you know every time I'm having a new episode or of the dividend journey or of something of this sort. However, let's move on, and we're going to dive a little bit further into the depths of ETFs and kind of have a big, I'll just show you. This is the definition that I pulled, and I pulled this definition from investopedia.com. We're going to kind of break down each aspect or sentence within this definition. So the first one is an exchange-traded fund, which is the acronym for ETF, or ETF is the acronym for exchange-traded fund. Those are what the letters truly mean. Is a type of security, so a stock or a something that can be bought and sold, a security, that tracks an index, sector, commodity, or other asset. We will break these down, index, sector, commodity, or other type of asset. We're going to highlight mainly index and sector, but that's moving forward. But can be purchased or sold on a stock exchange the same way that a regular stock can. And this is important as well. And the reason this is important is because index funds were around before an ETF. An ETF is an index fund that is traded on the market. An index fund is not traded on the market. If you go in and if you're familiar with my dividend journey, I invest in FZROX. It is FZROX. And what that is an index fund. And those are kind of simplified with the X at the end of it. But what it is it is a collection, a basket of stocks. Just the same way that an ETF is, that's all an index fund is. An index fund was actually the first version of it. But it was when you made the purchase, you said, all right, I'm going to put $500 in or $100 in. The purchase gets made at the end of the day. At least in Fidelity's FZROX it does. And it's at 4 p.m. So what you lack, what you don't have with an index fund is tradability, the ability to short it or use options on it. You can't do that. It's just literally a buy and a hold. With an ETF, you can do those things. Now, I do not personally short or you play options on any ETFs, but you can, and that's kind of the reason they were brought into mainstream, is because now you have flexibility with this, and that's really why they highlight that it can be purchased or sold the same way that regular stock can. So moving in, we're going to define index and sector and kind of what that is. Like why do we care that an ETF tracks these? So here are the two basics. We have the Dow Jones, we have index and sectors. The Dow Jones, the S&P 500, and the NASDAQ are all examples of indexes. Now, we're going to go a little bit deeper here, and we can view all of the market indexes. Now, really, what is an index? It's just a way that us as human beings can segment a portion of the market and then watch it. So the S&P 500 is the top 500 companies in the United States. The Dow Jones, the DJIA, is a collection of securities or stocks, the top 30 most influential. And so we can actually view Here is the Dow Jones, companies like 3M, American Express, Apple, Caterpillar, Cisco, Coca-Cola. The way that I defined it to my mom was essentially, these are the companies you think of when you think of stocks. These are the companies you think of when you think of the United States. They're influential, they're big, blue chip companies. That's really what they are. And even here, we can use Investopedia, which again, I said I was going to be leaning heavily on resources. Here's another resource, Investopedia.com. The Dow Jones is one of the oldest and most well-known and most frequently used indexes in the world, and it tracks the 30 largest and most influential companies in the United States. So that there is your definition of what the Dow Jones is. You can even move here to the NASDAQ, that most investors know of it as technology stocks, but it is actually a market capitalization weighted index of all the stocks traded on the NASDAQ exchange. So again, you're getting these definitions of examples of indexes. And you can look at them here. There can even be indexes for utility companies. We can click into here, the internet. Here's the Dow Jones Internet Composite Stock Index. And you can go ahead and view the companies that are involved in this if you search it up for yourself. Again, I recommend using these resources to do so. Here we can view companies in the S&P 500. We can click through and view companies that begin with the letter M involved in, oh, I didn't switch over to the S&P. Here we can view companies starting with the letter M that are involved in the S&P 500. So you can do your research, you can do your due diligence on the web using the resources that I have listed, but that is what an index is. Now, why would we want to track that? Well, why would you want to track the top 500 largest companies in the United States? Well, because they're the biggest companies in the United States, and more than likely, they will continue to perform. Another important thing to touch on with the S&P 500 in specific is that it makes up, there is a stat here somewhere. Here we go. The S&P 500 in general, or it represents approximately 80% of the total value of the U.S. market, and it gives a good indication of the U.S. market as a whole. All right, so continuing to move on, sectors. Why would you use an ETF to track a sector? Well, first we need to describe what is a sector. Well, there are 11 different sectors in the market, and here on NASDAQ's website, we can actually view these, and we can view the largest ETFs that are attached to those sectors. So you want to track maybe, health or health companies, you can do so. You want to track technology companies, you can do so using a sector-specific ETF. So here we have technology, healthcare, financials, real estate, energy, materials, consumer discretionary, industrials, utilities, consumer staples, and telecommunication. And you could go ahead, pause the video on any of these, or like I said, click the link in the description. I'm going to drop all these down there to really dive into, the technology sector, the healthcare sector, and you can view the different, what sets it apart, what is a stock that would fit in, etc., etc. Going back to the presentation here. So you can use those ETFs that are listed there, or there's, I'm sure, hundreds of other different options that you can also use to track the sector. Maybe you think that, technology stocks are going to outperform everything else, or maybe, financial companies or banks are going to outperform everything else. There are ETFs you can use to track just banks, or just, financial companies, just consumer discretionary companies. And you may want to, if you want to bet on the sector as a whole, invest in that. All right, so you cannot talk about the ETFs without talking about Vanguard, the GOAT of ETFs. So Vanguard really popularized ETFs. And again, something that I want to stress is I always mention VOO. I always mention VTI, both on public, on Twitter, on TikTok, here on YouTube, and the podcast. What are those two? What is VOO? What is VTI? Well, let's go ahead and pull those websites up. Here is VOO. It is the top 500 largest publicly traded companies in the United States. And you can go ahead and use this website to see all of them, but you can also use Vanguard in specific, their ETF that tracks the S&P 500, which is an index. You can use their website to find out what percentage of the basket, remember, The basket is the basis of everything. The basket is the ETF. The stocks go into the basket, which forms the ETF. And here you can see what percentage of the basket each company is. Currently, of VOO, Apple is the largest chunk of the basket at 6.64%, and then it goes down from there. You can also look at VTI, which this is the whole entire United States stock market, and you can see that Apple makes up less percent of this fund. The reason being, there's so many other different companies that need to get involved in this as well, and you can see they drastically drop. So as you move just down here, Chevron only makes up 0.46%. So you're not getting a ton of exposure to each individual company, but what you are getting exposure to is every company in some way, even if it's small. So that kind of touches on that point, and I think it's very important that I do bring those up, because again, those are the ones that I'm invested in. I am personally invested in VOO and VTI, and I don't necessarily recommend that you have to be invested in them, but I speak about them so much, so I wanted to bring them up. And the reason that they are popularized is their expense ratio. Now, this is what we're going to talk about next. What is an expense ratio? An expense ratio is how much it costs to be invested in an ETF. So an ETF, like I mentioned, is a basket, and other stocks are put into the basket and they form the basket. Well, if someone else did that job for you, they're going to expect some type of compensation. Expense ratios were born. So expense ratios are essentially the way that the company that makes the ETF gets paid. Now, the more work they do sort of sorting out that basket for you, the more expensive. So ARK Invest has been popularized as of late, and they're popularized because Cathie Wood and her team go through and they pick companies and they put them into different ETFs, and they say, this is going to be fintech. We're going to track all the fintech companies. We're going to track all the space companies. But she moves companies in and out of those baskets constantly. So she charges 0.75% to be invested in her ETF. Vanguard on VOO and VTI, because those are indexes and the people at Vanguard are not actively making the decisions to switch those companies out, they're able to charge a very, very, very low expense ratio at 0.03%. And these are kind of the two opposite ends of the spectrum. Now, 0.75 is not insanely high. It can go higher. And 0.3 is relatively low, although you can get index funds, not ETFs, but index funds that have a 0% expense ratio. This is how it affects. So let's say you had an initial investment of $10,000, and every year you added $5,000 more, and you got a 6% return over 30 years. Well, the Vanguard ETF is going to cost you about $2,566 to be invested. Can blow this up a little bit. The 0.75% expense ratio or ARK Invest is going to cost you $59,495. So you can see the difference there is massive. But, and I will remove myself here from being biased towards Vanguard or towards any specific investment, if the ARK Invest ETF can outperform the market or outperform any Vanguard ETF, well, then the cost might be worth it. But if you don't think that it can, then you might not want to make that investment in a high-priced expense ratio ETF. So those are expense ratios. There could be a whole video speaking about how they work and how they're charged and etc., but that's definitely a topic for another day. So why do we care about ETFs at all? Why do they matter, etc., etc.? Well, the ETF that I'm going to be referring to in this example is VOO or VTI, a market tracking ETF. Not necessarily a sector specific, but a market tracking ETF, but the principle stands no matter what. Let's say, well, over the past about 100 years, we don't have to say, we know, over the past 100 years, the market has returned about 10% on average, the market. So the whole entire market as a whole. It's returned about 10%. Now, if you decided to pick individual companies from the market and not invest in the whole market, you may very well beat the market. You might get 20%, you might get 50 or 100% or 1,000%. But that's very difficult to do. There's been very successful investors that cannot consistently do that. So you might get 5% or 1%, or you might have a negative return and lose money. So the reason that I bring this up is there are many ETFs, again, going back to those staples, VOO and VTI, and some others like SCHB, which is Charles Schwab kind of total market. You also have SCHD, which is more focused on dividends. These tend to do and track the market and do a little bit better job at getting the average return for their investors. So that's why we see the greater than or equal to whatever sign siding with the 10%, because picking the individual companies is difficult. And you might not do well. You very may, you could do well, but you might not. And so if you expose yourself to the broad market with an ETF instead, you allow yourself the chance to track the market and just do well as a whole. So I kind of sum all this up. I know this was a longer video. With an ETF is a basket of companies, of stocks. And that's really the core value. Now you can use that to your advantage. You can use it in any way you want. You might want to be more diversified, so you invest in an ETF. You might want to, track a sector or an index or do something else. So that's why you invest in an ETF. There are a ton of different reasons why you may do it, but I think that everyone can find an ETF that kind of aligns with their views and the way that they would like to invest. Now, this is not investment advice. Please do not go out and invest in any specific ETF without continuing to do more research. Like I said, all of the links will be below. I want you to go ahead and check those out, browse those, and use those. If you follow me on Public, which if you haven't already joined Public, you 100% should. You can get a free stock valued all the way up to $70. The link is going to be below for that, but I made a post over there with a ton of references. People are commenting and tagging others in it who are, then dropping more. A ton of links to all the different references that you could possibly want, trackers, websites, anything that you could imagine. People are commenting all different types of resources. So go ahead and check that out. If you don't already listen to the podcast and you like to listen to the podcast, listen to more of me rambling, anchor.fm/financial friends. You can find that. Listen on Spotify, Apple Music, Google Podcasts, a bunch of others. And with all of that being said, I hope that you were able to pull something out of this video. I've done a lot of talking, but I hope that you were able to get one tidbit of information that is new to you. And if you did, you can go ahead and leave a like. If you're not already subscribed, there's a large portion of you who are watching who are not already subscribed. If you can go ahead and do that, that would be greatly appreciated. And I hope that you all have a great day.